Welcome back. This is Mortgage 101. I'm Dan Olstrand. He is Clinton Wilkins, and we're into the final portion of this month's episode and our discussion on financial literacy. We've talked about debt, which is credit, to me anyway. We've talked about income, and the last part of the mix, Clinton, is assets.
I think assets is one of the biggest and most important to a lot of people. Here's an interesting fun fact. This is the 15th anniversary of Financial Literacy Month.
There you go.
Not the 15th year that we've been doing this, but the 15th year that the Financial Consumer Agency of
If
Canada
you've been doing this
has
for
put it on.
15 years, you would have been about 4 when you started, right?
I mean, my internal age is 33, but my government age, we all know it's a little bit higher. Anyway, we won't get into that. One thing that we were saying during the break was that typically older folks have better credit scores because they have a longer time to be able to pay. So younger people can have good credit too. I always say start them early. But assets so important. And the biggest asset in many Canadian households, guess what? It's their home.
Right.
And this is where it's challenging for folks that are renting. And sometimes it's hard to break into that property ladder. But before we even started the show, I said that I had customers that were in their 80s that were going to be buying a condo.
Which was shocking to me. There's no top end to when people can get into the housing market.
No, and guess what? These customers that I saw that were in their 80s, 30-year amortization. They're like, longer the better, baby. Because, they don't have any plans to pay it off. They're like, we might live until we're 100, but we're probably not living to 110. And they'd been renting the last 20 years. And they said, well, we wish we would have bought 20 years ago when we retired and sold our home. We've been living in an apartment. But guess what? Their situation with the apartment has changed. And that apartment now is getting turned into condos. They want to buy the condo, et cetera, et cetera. So, I will say it's never too late. We also see first-time home buyers that are in their 50s. It really does happen. And again, I will say that the asset is the biggest, or the home is the biggest asset oftentimes in a household. Mortgage is the biggest asset, so that's why we're here around. But it's not the only asset. It's important to protect the asset, obviously. It's important to build it up. And, we've had a very good job here in Halifax of if you bought a home in 2020 or before, your asset's probably close to doubled in value. But there are other assets that might be important if you're a renter or even if you are a homeowner building it up. And I think one of the first ones and the first thing that really comes to mind for me is an RRSP. Some people have pensions through work, not everyone. Some people have some RRSP plans through work. But in Canada, you can contribute 18% of your income up to around 150 some odd thousand this year. So there's a lot of money that you can contribute every year to an RRSP. And I always recommend for consumers, make it automatic. If your work has a plan, get it set up with work. Sometimes they even do matching. Take advantage of that free money. And if your work doesn't have something, get it set up wherever you're doing your banking or get it set up with a financial advisor. But get that debited from your account every time you get paid. If you get paid biweekly, contribute to that RRSP biweekly. If you get paid weekly, do it weekly. If it's semi-monthly, do it semi-monthly. Make it automatic. You won't even know or see or miss the money. And you also get your tax benefit. When you contribute to your RRSP, you're going to be getting that portion of that taxable income back. And I always encourage people, I'm like, when you get that tax check back, you contribute that to your RRSP as well, if you have room.
Clinton, I hear from people that are looking at getting in the investment world and looking at RSPs and saying, well, okay, I might be in a situation today where that makes sense, but who knows what's going to happen tomorrow? And I'm scared that money's going to be locked away.
And you might need access to it.
Right.
So if you have an RRSP and you're a first-time home buyer and you're buying a home, you can actually withdraw up to $60,000 from your RRSP and you have 15 years to put it back in, which is significant. But if you're not a first-time home buyer and you might need access to the money, I think a TFSA is a great place to start because any of the earnings within the TFSA, tax-free. I love it. My TFSA maxed out. I love making money in my TFSA, and I usually put more risky investments in that TFSA because if that pays off, guess what? I'm going to cha-ching and make a couple dollars here. And the TFSA limit is based on how old you are. So every year, the government allows a certain dollar amount that can increase, and you can put that in there. So I think a TFSA is a great plan. And down the road, if you want to take money and put it in your RRSP, if you have a limit, you can certainly put that money from a TFSA into an RRSP. That's not a problem. But if you might need access to the funds, the TFSA is really a good way to start. Another one that people are not really talking about, and it was an initiative from the government a couple of years ago, the first home savings account. It's huge. And especially only for first-time home buyers would this make sense. But if you're planning on buying a home, I would definitely look into a first home savings account. You don't hear very much about it, Dan. And there's a lot of confusion and a lot of, we don't know how much we can put in. Can we put it in this year?
So how does that work? Does it work like an education savings plan?
Similar type of idea, but the amount can only be used towards buying your first home. So again, like a RRSP, like a TFSA, it's another asset facility that's earmarked specifically for first-time home buyers. So even if you have a first home savings account, you can still do the RRSP withdrawal. It's not excluding you from doing that. And every year that goes by, you can contribute more and more to that first home savings account as well.
And if you put the money into that account and you don't buy a home, what happens?
That's actually a great question, Dan. I've never been asked that one before, but that's a good one I'll take away, and maybe we can answer this at the end of the month when we do our live show.
There you go. It's called force tuning. It gets people to tune
and
in.
I don't want to give people the wrong information, but let me go and research that one.
Because I know with education plans that if you contribute to an education RESP, it's called, and if your child doesn't go to university, then there's a mechanism that you can access.
Can get a portion of it back, but you don't get it all.
Right.
I think it's probably a similar type of idea, or maybe it becomes taxed at that point, but we'll look into it and we'll report back at the end of the month.
Right. And Clinton, obviously assets and investments are important, but as you said a couple of times throughout the episode today is everybody's kind of stretched.
Mm-hmm.
There's usually more a month than a paycheck these days. But it's vitally important that, even if it's a small amount, that you start to sock some things away for a rainy day.
I think some of it's behavioral, Dan, honestly. It's not so much about the dollars or cents. It's getting into a habit and then changing that habit over time. And I tell people, make it automatic. And when you're paying your mortgage, or if you're paying down your debt, or if you're contributing to increasing your net worth, building an asset, make it automatic, set it and forget it. It becomes a lot easier. The other thing that I will say, there's certain hacks. So typically, most people, they get a raise every year or every couple of years. And yeah, some of this will go to the government, but whatever's left in your bank account, if you're living within your means, how about take that increase and then maybe take that increase and put it on your debt? Or if you don't have the debt, take that increase and put that into an investable asset. These are easy things that you can do, and I call them like little micro increases that make a difference. And right now, consumers by and large are making more money in the marketplace than the cost of borrowing on a mortgage. So when people are asking me, should I pay down my mortgage faster and increase the net worth and the assets, in our family? Oftentimes I say, I think you need to talk to your financial advisor first to see, does it make more sense for you to contribute to an investment versus paying down the mortgage?
And that's an interesting point, Clinton. And a lot of people don't even consider paying down their mortgage quicker than is prescribed in their original document. And there is some fallacy out there that there's penalties attached to that.
Yeah, and I think that's a misconception as well. Most mortgages come with a prepayment privilege. A lot of the lenders that we deal with every day allow a 15% annual lump sum payment. Some of them allowed 15% payment increases, and some of them even allow you to do double mortgage payments. And you can do all of these things. So some consumers can pay down their mortgage as quick as 5 years if they take advantage of all of the prepayment privileges. But what I say to a consumer, you have all these privileges. A lot of people won't take advantage of them. And usually the people that are either get a big inheritance or they've won the lottery. So you decide which path that you're going to be going down.
I'd like to win the lottery.
I mean, I would too. You can't win though, Dan, if you don't play.
Right.
And I'm not saying that I condone gambling, because I usually tell consumers, this is one of the funny kind of phrases that I say when I'm explaining a mortgage commitment. We go through all the details. And I say, as a reminder, the bank is like the casino. They won't lose.
The house never loses.
The house never loses. So understand your terms and conditions. Seek the advice of an unbiased mortgage professional, because we deal with a bunch of different lenders. And not all lenders are the same. I would say, Dan, more so now than ever before, the differences between lenders and mortgages is more today than it ever has been.
Clinton, it's been a lot of fun. This is the second time this year that we've had an opportunity to sit down. I always learn something when we do this, and I hope that listeners out there learn something today as well.
I hope so. Financial Literacy Month is so important. We're kicking this month off right. Break down these barriers, have the conversations at home, And we'll be back here at the end of the month. We're doing a live show during the week, and we'll bring some guests on as well.
And hopefully you'll learn a little bit more there. Thanks a lot, Clinton. I've enjoyed today's episode, and I hope that you did as well. Don't forget, these episodes are available everywhere. Clinton's website. You can check them out on our website if you want to go back and review them. We'll post this audio up for you and give you an opportunity to listen to it again. Until then, everybody, have a fantastic day. Enjoy your weekend, and we're back next month.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.